Cognitive bias in accounting decisions. Introduction. Accounting decisions play a crucial role in the financial health and transparency of organizations. However, these decisions are often influenced by cognitive biases, systematic patterns of deviation from rationality or sound judgment. Cognitive biases can affect accountants, auditors, financial analysts, and other decision makers, leading to errors, misstatements, and even ethical lapses in financial reporting. What is cognitive bias? Cognitive bias is a psychological phenomenon where individuals make judgments that are systematically skewed due to mental shortcuts, heuristics, emotional influences, or social pressures. In accounting, where decisions often require judgment under uncertainty, cognitive biases can distort analysis and lead to suboptimal or unethical decisions. Common types of cognitive bias in accounting. 1. Confirmation bias. The tendency to favor information that confirms existing beliefs or hypotheses and to ignore contradictory information. Example, an auditor may focus only on data that supports management's financial estimates and overlook evidence that suggests possible misstatements. 2. Anchoring bias. The over-reliance on an initial piece of information or a reference point when making decisions. Example, an accountant might anchor on the previous year's revenue figures when forecasting current year revenue, even if market conditions have changed significantly. 3. Overconfidence bias. An inflated belief in one's own abilities or the accuracy of one's judgments. Example, a financial analyst may underestimate risks because they are overconfident in their forecasting models. 4. Availability heuristic. Judging the probability of events based on how easily examples come to mind, rather than on objective data. Example, after hearing about a recent accounting scandal, an auditor might overestimate the likelihood of fraud in their current audit client. 5. Hindsight bias. The tendency to perceive past events as having been more predictable than they actually were after the outcome is known. Example, an auditor may unfairly judge management decisions by assuming they should have anticipated negative outcomes. 6. Self-serving bias. Attributing successes to one's own skills, but blaming failures on external factors. Example, accountants may take credit for successful financial forecasts, but attribute failures to unpredictable market conditions. 7. Escalation of commitment. Continuing to invest time or resources into a failing course of action due to prior commitments. Example, management may continue to invest in a losing project because they have already spent a large budget on it. 8. Framing effect. Decisions are influenced by how information is presented rather than just the facts themselves. Example, an auditor may assess risk differently if a scenario is framed as 90% chance of success versus 10% chance of failure. Assessment or overlooking red flags.